Warren Buffett says that the CEO's most important job is capital allocation. Now, that's something that probably sounds pretty boring and quite frankly, mostly irrelevant to your investment thesis on a given stock, but it is of the utmost importance. To illustrate why, we're going to do a deep dive into Facebook's capital allocation. I think this is the primary reason why the stock has absolutely tanked so far this year. And at the end of the video, we're going to give Mr. Mark Zuckerberg a bit of advice that I think might turn Facebook stock around.
This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
As a reminder for those of you who are supporting me on Facebook and Patreon, my Q&A for November will be closing here over the weekend. I'll put a link in the description below if you want to get a question in. Thank you to everyone who is currently supporting me on Patreon and via YouTube. If you want to support me in other ways, you can also check out my valuation course, which is currently in a beta mode. If you have any ideas or questions you'd like to ask about valuation, I'd love to get those from you and include those in the course. So first of all, what is capital allocation? When a business makes a profit, basically they have a couple of options. Let's say Facebook earns a $10 billion profit in the particular quarter that we're in. Capital allocation simply is how they choose to allocate this capital, this incoming capital. So there's essentially two kind of main branches. There is returning cash to shareholders, and that happens in one of two ways. The business could either pay a cash dividend, which goes into the shareholders' brokerage accounts as cash, or they can buy back their own stock. And we'll talk more about this particular issue for Facebook in just a second. Of course, if you're following Facebook, they pay a $0 dividend, but the buyback has been substantial. The other option the business has is to reinvest back into the business for either future growth, or in some cases, it's just to maintain. So maintenance expenses are pretty much unavoidable. It's like, imagine if you had a factory or something, right? So the factory is eventually going to need repair and replacement just to maintain the current income of $10 billion. The growth, on the other hand, is for things like adding a second factory. So the key really is this growth. If the company does a really good job of investing in growth projects, they can create future income streams that they would not have otherwise had. So if you have a business that is extremely good at capital allocation, they can invest money on your behalf at high returns on capital, maybe 20% or greater. And in that case, you much prefer that the business would invest on your behalf. If the company earns a low return on this invested capital, or in some cases loses money on it, it doesn't ultimately pay off, then you would much prefer that they return money to you, either via dividends or buybacks. And this, I think, is where they are going wrong. In the words of our former president,
big league, big league, big league.
First, let's start with buybacks. A friend of mine who is also a coworker, shout out Matt if you're watching the video, he sent me this tweet and I thought it was absolutely fascinating. It shows Meta, which is Facebook's parent company. Obviously, they changed the ticker from FB to Meta, just in case you weren't paying attention, but they have purchased a ton of their stock over the last 12 months. So from July of last year through June of this year, they repurchased $48 billion worth of their own stock. The average price they paid for those purchases was $303. Today, the stock price is right at, or maybe a little bit under, 100. So that means this current investment of $48 billion is actually currently worth about $16 billion, which means that Facebook has cumulatively lost investors $32 billion just via the buyback. And if you calculate what $32 billion is over the current market cap of $266 billion, it works out to about 12%. So Facebook has destroyed 12% of shareholder value in 1 year just by having a buyback program that purchased their own stock at what appears to be a pretty elevated price. And you can see that as time has gone on and the stock price has started to decline, look what is happening to the buyback. It went from 6.2 billion in January of 2022 all the way down to today, under $1 billion in June, and I'm sure that is continuing to decline. So the buybacks are decreasing with the stock price. And obviously, if you're buying back your own company's stock, you want to, spend less when the stock is high and more when the stock is low. So Facebook is clearly doing a pitiful job on their buyback program. The next major area of concern is what Facebook is doing to invest in growth. Here is Facebook's net income in millions of dollars going back to Q3 of 2020. You can see that it's been running around the $10 billion mark per quarter. However, you see a major drop-off starting in Q1 of 2022, and this is where they officially reported a $3 billion loss on their metaverse investment program. Horizon Worlds is what it's called. This loss has continued. So in the most recent quarter, it was over $3.6 billion lost in that one program. And if you just compare that to their net income, almost half of the net income is currently being lost investing in this Horizon Worlds metaverse project. Now, could this eventually pay off massively? Of course it could, but at the moment it appears that Meta is just hemorrhaging money on this project, and there appears to be no end in sight and no return on investment that's anywhere close to today. Maybe Zuckerberg is thinking way ahead of their peers, but right now it looks like a major investment black hole, and the market absolutely hates it. And you can see if you simply would just get rid of this, say just cancel this entire project, it would start to increase Meta's net income by another $3 billion per quarter, or $12 billion roughly per year. Instead of allocating capital in the way that Meta is currently doing it, I think they would be a lot better off, and their shareholders would be a lot better off, if they would convert from a reinvestment and buyback machine into a dividend machine. If they would just change a couple things about capital allocation, Meta could actually become one of the most impressive dividend payers in the entire market. Here is Meta's cash flow statement, and this is a quarter old. So in the most recent quarter, they earned $4.4 billion in net income. And if we just assume the same decline in net income as cash from operations, we can calculate their cash from operations is about $10 billion. So the first thing I would do is just stop investing in the metaverse, or at least not invest so heavily. So if we add that back, we come up with $13 billion in cash from operations. They're currently spending $7.5 billion in PP&E or CapEx. I'm sure some of this is going towards growth projects. So let's just subtract this, which means that Facebook would have $5.5 billion per quarter left over in free cash flow that they could choose to either pay a dividend or do a stock buyback with. So if we multiply that by 4 quarters, we can calculate that Facebook would have about $22 billion left over to return to shareholders. And if they would do this entirely in a form of a dividend, their dividend yield would be staggering. You could take this $22 billion divided by the current market cap of 266, which would mean the dividend yield of Facebook today would be a staggering 8.2%. Now, I would imagine if they would pay an 8.2% dividend, investors would absolutely flock. I mean, they could even do half of that. I mean, do a fourth of that, and I think investors would love it. So that's what I would do to fix Meta. But I think the most important takeaway for you, whether you're investing in Meta or not, is that capital allocation absolutely matters. If you own a company that is continually buying back their stock, it's very important that that stock purchase be done at a good price. If the company is buying back shares when the price is at highs and not buying it back whenever the price falls by 50 or 60%, like it did with Facebook, the company is destroying shareholder value. You would much prefer that the business just simply pay out a dividend. You can choose to reinvest in the business if you want to do that, or you could keep it. Obviously, it's going to cost you some additional taxes, because it's forced taxes if you get the dividend. But I think in this case with Meta, it would be much better for us as investors to get that dividend. We can make the choice if we want to reinvest in Meta or invest in something else. For the growth project, I'm certainly no expert on the future of the metaverse. It may be something that is a really big deal and ultimately pay out for shareholders big time. But in the current environment, I think the market's appetite for that kind of aggressive investment is very low. Obviously, you've got a lot of economic uncertainties. So I think just paring back on that investment would be a wise thing for them to do. I think the market would absolutely love that. So let me know in the comments below what you think of Meta as a stock right now. Do you think it is a good value and a tremendous long-term buy? Or are you waiting on them to make some changes? Let me know in the comment section down below. Thanks for watching, and I will see you in the next video.